Why are some of the biggest crypto investors quietly leaving certain altcoins while the public is still buying them? Why are wallets connected to venture funds, early whales, and even developers slowly reducing exposure? And the strangest part? Most people don't even notice it happening. The charts still look normal. The influencers still sound bullish. The narratives still feel exciting. But under the surface, something is changing. Because historically, in every single cycle, the smartest capital doesn't leave loudly. It leaves quietly, slowly, strategically. And if you understand why it happens, you can protect your portfolio long before the market reacts. So today, we're going to break down exactly what's happening, why smart money is quietly leaving certain altcoins in 2026, and more importantly, what signals they're watching that most retail investors completely miss. Let's start with the first, and probably the most misunderstood reason. Number one, liquidity always comes before narratives. Most people in crypto think price moves because of news, or hype, or social media trends. But experienced investors know something very different. Price moves because of liquidity, always. Liquidity is the fuel that drives markets. Without it, nothing moves. And in crypto, liquidity behaves in cycles. At the beginning of a cycle, liquidity flows into the safest asset, Bitcoin. Then it spreads into large cap altcoins, then mid caps, then small caps, then eventually the most speculative projects, meme coins, low liquidity tokens, experimental ecosystems. This phase is when retail investors feel like geniuses. Everything pumps. Random coins do 5x, 10x, sometimes 50x. And suddenly, everyone thinks they've discovered the next big project. But here's the part people forget. Liquidity doesn't stay there forever. It eventually reverses direction. And when it does, smart money doesn't panic. They simply rotate, quietly, back into assets with deeper liquidity. Bitcoin, major infrastructure, assets with real demand. You can already see signs of this happening. Large wallets are increasing their Bitcoin allocation. Stablecoin balances are growing on exchanges. Meanwhile, many altcoins are showing declining volume. That doesn't always mean prices crash immediately. Sometimes prices drift sideways for months. But the underlying liquidity slowly disappears. And when liquidity disappears, volatility follows. That's why smart money starts exiting before the public realizes anything has changed, because they're not chasing hype, they're following liquidity. Now let's move to the second reason. This one is even more important. Number two, token unlocks are about to change everything. One of the biggest structural risks in the altcoin market is token supply. Many projects launched with aggressive vesting schedules, venture capital funds, early investors, team allocations, ecosystem funds. All of these tokens were locked for months, sometimes years. But those locks don't last forever. Eventually, those tokens unlock. And when they do, they introduce massive new supply into the market. Think about it this way. Imagine a token with a circulating supply of 100 million, but the fully diluted supply is 1 billion. That means 900 million tokens are still waiting to enter the market. Now, imagine those tokens unlocking during a period where liquidity is already shrinking. Suddenly, the market has to absorb enormous selling pressure. That's why experienced investors track token unlock schedules extremely closely. They know when supply is about to expand, and they position themselves ahead of time. In 2026, billions of dollars worth of tokens are scheduled to unlock across multiple ecosystems. Some of these unlocks are larger than the daily trading volume of the tokens themselves, which creates a simple problem. Who is going to buy all that supply? Retail demand alone rarely absorbs it, and venture funds usually don't wait around hoping for the best. They manage risk. They exit gradually, weeks or months before the unlock events even happen, which is why you often see the same pattern repeating across altcoins. The price peaks, then trades sideways, then slowly fades, long before the unlock news becomes widely discussed. Smart money was already preparing because they understand something most retail traders ignore. Supply matters, and when supply increases faster than demand, price eventually adjusts. Now let's move to the third reason. This one has less to do with charts and more to do with psychology. Number 3, retail attention is spreading too thin. Every cycle, the crypto market creates thousands of new tokens, new chains, new narratives, new ecosystems. Artificial intelligence coins, gaming tokens, layer 2 scaling solutions, real-world asset protocols, decentralized social networks. The innovation is exciting, but it also creates a problem. Attention becomes fragmented. 5 years ago, the altcoin market focused on maybe 20 major projects. Today, there are thousands, and attention is one of the most powerful forces in crypto markets because attention drives capital. If millions of investors are watching the same asset, liquidity concentrates, momentum builds, price accelerates. But when attention spreads across thousands of projects, liquidity spreads too. Instead of one altcoin receiving billions in inflows, hundreds of tokens receive small amounts, which weakens momentum across the board. This is something smart money understands very well. They know that attention cycles are getting shorter, narratives rotate faster, and maintaining long-term liquidity in smaller altcoins is becoming more difficult. That's why many institutional investors are simplifying their portfolios. Fewer tokens, higher conviction, assets with strong developer ecosystems and real adoption, not just narratives, because narratives fade quickly. Usage doesn't. Now let's move to the 4th reason. This one is subtle but incredibly important. Number 4, infrastructure projects are quietly absorbing capital. When retail investors think about crypto profits, they usually imagine explosive altcoins. But institutional investors think differently. They focus on infrastructure, blockchains, scaling solutions, liquidity layers, interoperability protocols, assets that support the entire ecosystem. Because historically, infrastructure captures long-term value. Think about the internet. The biggest companies weren't always the flashy consumer apps. They were the platforms powering everything behind the scenes: cloud computing, search engines, payment networks. Crypto is following a similar pattern. Some of the largest capital flows today are moving into projects that strengthen the underlying architecture of blockchain networks, data availability layers, modular blockchains, high-performance settlement layers. These projects may not always produce instant 10x moves, but they attract deep, patient capital, which is exactly the type of capital that stabilizes markets. Meanwhile, many speculative altcoins depend almost entirely on hype cycles, and when hype fades, liquidity fades with it. Smart money recognizes this difference, so they gradually shift capital into infrastructure plays, long before retail attention catches up. Now let's move to the 5th and final reason. This one is the most psychological of all. Number 5, smart money remembers the last cycle. Retail investors often treat every bull market as if it's the first one, but experienced investors carry scars from previous cycles. They remember 2017. Thousands of ICO tokens launched. Most of them disappeared. Then 2021. Hundreds of DeFi projects exploded. Many collapsed within months. And today, many of those tokens trade 90% below their peak. This history creates a very different mindset. Smart money knows that most altcoins will not survive multiple cycles. Very few projects maintain relevance over 8 to 10 years. Technology changes, narratives shift, communities move on. So experienced investors approach altcoins with a different strategy. They treat them as temporary opportunities, not permanent holdings. They accumulate during early momentum, ride the growth phase, then rotate capital once risk increases. Retail investors often do the opposite. They fall in love with projects. They believe every narrative. They hold through every downturn, hoping the market will eventually reward them for patience. Sometimes it does, but most of the time, capital simply moves elsewhere. And this is the key difference between smart money and emotional investing. Smart money focuses on probabilities, not attachment. They constantly ask one question: where is capital likely to flow next? Not where it flowed last year, not which project has the loudest community, but where liquidity is most likely to concentrate in the future. Now, here's the part most people don't want to hear. Smart money leaving certain altcoins doesn't mean crypto is dying. In fact, it usually signals the opposite. It means the market is maturing. Inefficient capital is being filtered out. Weak projects lose attention, strong ecosystems continue building, and over time, the market becomes stronger, more resilient, more selective. Just like every other emerging technology industry, the internet went through this too. The dot-com bubble eliminated thousands of companies, but the survivors became some of the most valuable businesses in history. Crypto may follow a similar path, and that's why understanding these cycles is so powerful. Because the goal isn't to avoid altcoins entirely. Altcoins will always create opportunities, but the key is recognizing when the environment changes, when liquidity tightens, when supply expands, when attention fragments, when narratives fade. Those moments are when smart money quietly adjusts their strategy. They don't announce it on social media. They don't panic sell on headlines. They simply reposition, slowly, strategically. And the investors who learn to read those signals often stay one step ahead of the market. So if you take one lesson from this entire discussion, let it be this. In crypto, price movements are rarely random. They reflect deeper forces: liquidity cycles, supply dynamics, investor psychology, technological evolution, and the people who study those forces carefully tend to survive multiple cycles, while others repeat the same mistakes over and over. So the next time you see an altcoin trending online, ask yourself a simple question: is smart money entering or quietly leaving? Because the answer to that question often determines the next phase of the market. If you found this breakdown useful, consider subscribing. This channel focuses on understanding the deeper mechanics of crypto markets, not just hype, not just headlines, but the real forces shaping where this industry is heading. And as crypto moves into the next phase of adoption, those insights will matter more than ever. Thanks for watching, and stay curious. Disclaimer. By watching this channel, you acknowledge that you understand the risks associated with cryptocurrency trading and investing, and you are solely responsible for your own trading decisions.